one of the last talks of the day, so it's truly an honor. My name is Daniel Smith, head of data at Blockworks, and I'm joined today by Felipe, who's the Chief Investment Officer of Thea Research, and Ryan Connor, who's the head of research at Blockworks. We're talking today a bit about our token transparency. So last week we launched a framework that ourselves on stage, as well as Louis from L1D, put a lot of effort into, and it's centered around token disclosures. So when we looked at the market, there's a pretty clear problem where we simply weren't disclosing information. And while that's not inherently a bad thing, what it does is it enables bad actors to profit off of ambiguity that, and basically, if no one ever asks you to answer the question, then you don't have to. You don't have to answer it. And unfortunately, that created a bit of an unfortunate market. But Felipe, I'll kick it over to you to kind of explain about the lemon market problem and what that ultimately means for the crypto space.
Thanks, Dan. So we at Thea, we're liquid token investors. We basically only focus on liquid tokens. And over the past few years, we'd seen a problem developing where we thought that liquid tokens were becoming a lemon market. A lemon market is essentially an adverse selection market where people who have better options don't launch, right? And the reason that was happening is because there wasn't a credible signal to differentiate good token actors that treated token holders as partners in the capital formation and business development process, and people who were essentially treating token markets as exit liquidity. So, there's a lot of problems, and we'll go over them in a lot of ways that you can treat token markets as exit liquidity. A lot of them are outright scams or fraud, and some of them are just things that had developed in the market that were adverse to token holders. And because of these issues, and because token holders couldn't tell whether they were dealing with a good actor, which we call lemons, or a good actor, which we call peaches, or a bad actor, which we call lemons, the good actors were choosing to not launch tokens, and the bad actors were filling up the market and creating this downward spiral where, the more lemons are on the market, the bigger discount you give to the market actors, and the bigger the discount, the less likely good actors are to join the market. That's the spiral that we were currently entering and kind of in the middle of with the market. And I think the token transparency framework will go a long way towards remedying that.
Yeah, what we really wanted to do was give projects the ability to communicate this essential set of information to the market, right? Like previously we saw this in a bunch of different ways, maybe a Discord chat, maybe a link in the docs, maybe a blog post on an obscure site, and maybe you'd only get 1/10, 1/3 of this information at best. Ryan, I'd love to get your perspective, right? You came from the traditional finance world, and talk a little bit about the disclosure regime that existed there, and your reaction when you came into crypto, and it's like, oh, like nothing like this exists.
Yeah, totally. Okay, I got into crypto personally in 2019, and there was no data. And then the people that I invested with wanted to invest in 2020 and 2021, and there was only TVL. And then I thought, man, this is going to get so good so quickly, and it didn't. It got a little bit better. We only now recently have revenue time series, so that's like a new thing that people are starting to understand exists. Compare that to TradFi think about TradFi where if a company goes public, I can go onto my Bloomberg terminal and I type in the ticker and I type in FA and I see all the financials. Or I type in the ticker and I type in own and I see all the owners when they've sold, when they accumulated their position, and what that ownership has looked like over time. Nothing like that exists today in crypto, and that to me is a huge problem for capital allocators coming into crypto. They're used to a certain level of disclosure. They're used to a certain level of fairness and disclosure, and their compliance officers are too. And even if they're really excited about crypto, even if they understand the power of the technology, they will run into real roadblocks bringing these ideas to their investment committees when this information simply doesn't exist, or it's like deep in a Discord somewhere. Again, I can go onto Bloomberg Terminal, I can type in DES, and I know what a business does. Doesn't exist in crypto, and if it does, it's in the Telegram group, and that's simply unacceptable to people who want to allocate capital. And I think crypto, it's my view that if we don't do this token transparency thing, or if we weren't to do this token transparency thing, I think crypto would be permanently starved of capital indefinitely. So I think this effort's critical.
Yeah, and so with Circle's IPO, you actually saw this happen. A couple weeks before the IPO, their S1 becomes public, and everybody is arguing about the same set of information that is listed on this S1. There's no random pieces of information that other people have, maybe more professional investors have, that retail doesn't have. Everybody can see it. And then you get to argue over the merits of the business, right? So crypto Twitter took a pretty aggressive stance that Circle as a business was not that interesting. They were paying a bunch of money to Coinbase, and then the rest of the market could have their opinion. Now we're a few weeks out, and I think most of crypto Twitter was probably wrong. The stock's up 8x, but the point being, all of the information was made available through this one-time filing called an S1. So we wanted to bring something like that to crypto. But the reality is you need to thread a bit of a needle here where you can't shove full gap accounting in the traditional disclosure regime onto a startup of 8 people. It's never going to work. So what is the minimum viable disclosure, and how can we get closer to that was something we thought a lot about. But Felipe, you as a fund, I'm curious, when you're doing due diligence and you're trying to get these questions answered from these projects, if we couldn't build this in a way that was useful for you in that process, then I think we failed. So I'd love to hear a little bit about your perspective. We launched only a week ago. There's only 5 projects, but if you fast forward to a world where there's 100 projects that have all completed this framework, how does that make your life easier if it does at all?
Well, a lot of our diligence is answering the questions that you have in the framework and trying to get fair answers about, one, how do teams think about token, launching second tokens, sharing revenue between tokens and equity, trying to suss out or figure out if the teams are siphoning cash away from the business entity, or if they're selling tokens and not revealing those things. Those, you mentioned Circle, those are not questions that people who invest in equities need to think about at all, right? If you're investing in equity, you know that the team cannot siphon off cash to another entity. You know that the team cannot launch a second equity, second stock and rug you. And you know that teams can't run away with cash. We say this story all the time. We invested in a company, early last year that went from $0 of revenue to $40 million of revenue in about 3 or 4 months. We were pretty excited about that. It's a pretty good outcome for a company. And the team decided that the revenue no longer belonged to the token, it belonged to them, right? So they created an offshore entity, moved to Dubai, and keep now 100% of the revenue instead of 10%, which was their token share. That's not that surprising to all of you because it's a rug. We have a word for it. We have vocabulary around it. It's a token rug. There is no chance that that happens in equities, right? There's no chance that Tim Cook decides to take all of Apple's revenue and send it to his own company. It's funny, but it also has a real capital impact because when we raise funds from allocators, we tell them how the market is, right? We're upfront with them, and they say, well, you need to earn a much higher return than my equity managers or private equity managers because you're dealing with all of this kind of fraud, waste, and abuse on the token side. And what does higher return mean? That means you have to invest at lower valuations. So it's a problem that impacts everybody. But back to your question, Dan, this is diligence that we do constantly as we're working. It takes multiple calls and kind of ongoing monitoring to make sure that companies are behaving appropriately and treating us as partners. And so you save me a lot of time that way, where we are now able to see everything on one dashboard directly and verify it with the sources. But you're also making it public, which I think is quite different. So we actually had to cut 2 companies in the past 2 weeks because as we were trying to put them on the token transparency framework, we asked them if they would join, and they said that they wouldn't. So that's suspicious. Why wouldn't you join? There's a little bit of blood in the water. And then we started to dig deeper, pull on the thread, find out why they were suspicious about joining or not, or nervous about joining. And we figured out that they were doing a few things that may be normal in crypto, but are not okay with us, and that we had been misled or lied to. And I think that will happen a lot over the next few weeks and months as people look on the token transparency framework and say, hey, this is not the answer that you gave me during diligence. Because one thing is saying something on a call, and another thing altogether is putting it out there on the Blockworks website that people use to make investments for the world to see and verify.
Yeah, and so I think what's also interesting here is I think professional capital allocators have a bit of an advantage in some sense, right? You can get the founder on the phone, you can ask these questions in a one-on-one sense, but the average retail market participant cannot do that. So there's also a bit of a leveling of the playing field here, where now they can get that access to the information because yes, it's an open source framework. Anybody can see the contents of the framework, see the responses by the teams, and that does all live at blockworks.co/token transparency. And it's free for projects to participate. There's no charge, and right now we have it created as a one-time filing. So, like again, going back to the S1 example, when you launch your token, you would ideally put this out alongside that. Now, there's a huge retroactive effort we have to go through because many tokens already exist. But when we think about the framework itself, it's broken down into 4 categories with a total of 18 criteria in total across those 4 categories. So the project and team information around how the team's structured, the equity token relationship, and other variables around this piece. So I think with the overarching piece of the framework, what we're trying to do is just push the information to the market and let the market decide of good, bad, right? We're not trying to pass a value judgment on any of this. And so a reason why that's the case, I think, is a really good example with the equity token relationship. We don't, as an industry, I don't think we know what the best format or structure is between how you should have, this is the entity structure the devco should be, and maybe you should or should not have a foundation. Maybe you should use a Duna or a Borg. There's all of these different ideas, and so the goal is to just say, okay, why would we say rate you higher based on your structure rather than just push the information to the market and then let everybody decide for themselves. Again, so really pulling from that S1 style framework. The actual scoring, though, because there is the transparency score, the reality is none of this is a law or a regulation. Right? We're not in that position to make that. So we had to have a way to measure essentially completedness of the framework. Because you could simply answer NA, and that would be an answer. And so we had to figure out how to grapple with that challenge. So the goal of the scoring mechanism is a transparency score. Again, not a quality score. So, for example, it's did you give a full, complete answer to the particular question rather than did you meet some structure styling? So that's kind of the broader points around it. But Ryan, I don't know if there's anything you want to add on the actual contents held within the framework itself and why those questions are being asked and why it's important to bring that information into the market.
Yeah, we're asking them because it's the minimum amount of information that you need to take money from someone. It should be very, very low lift to fill this out for teams. We're very cognizant that these teams are startups, that they have small teams, and that they're moving very quickly. But there is, a lot of people in the industry feel this way. There's just a minimum level of disclosure that you need to hand over money to someone. There's a fiduciary obligation, and it's designed to be very low lift, which is, I think, why we're seeing the strong demand that we've seen since launch.
Yeah, we also are very much viewing this as an evolving framework. As much as I would love to sit up here and say we've launched the cure to everything and it's done and over with, the way I've been talking about this is if you're rating the industry's level of transparency on a scale of 0 to 10, we were at about a -2. And the framework as is today probably gets us to a 3 or a 4. And I think there's a couple small tweaks we can add to get to a 5 or 6, and then a 7 or 8. And over time, I think we will get there. Maybe one example of this is, again, right now it's set up as a one-time filing. Hester Peirce's Safe Harbor 2.0 recommends that you actually have a 6-month update period. So, TradFi standards are maybe quarterly. We can do something that's a little bit more lightweight, yet still getting that information to the market on a regular basis. And then another piece that we're also excited to continue iterating on is just the overall language and also how we're auditing it. So got to give a huge shout out to Ryan and Robert from our team who have been putting an enormous amount of effort into ensuring that the responses we get are meeting the standards that they need to. Again, there's no precedent here. Nobody's ever asked these teams to disclose this information before. So to get the right responses that actually drive this information into the market has been a bit of a challenge. I think that's going to naturally kind of self-correct itself. We only have 5 live today. We'll have another 5 live next week. And by the end of the year, we'll have something somewhere in the ballpark of about 100 names live on this thing. That's the goal, and that's what we're marching towards. So the call to action would be, if you're a project, as Felipe mentioned, this is a tool to be a credible signal to the market that says, hey, we believe we're doing things the right way. Here's how we're doing it. We just want to communicate that. I think another interesting area worth discussing is sort of like the centralized exchange listing agreements and market makers. This is one where I think there's a ton of opportunity for us to tighten up the questions and get more specific. But we need to work as an industry because there's a lot of different moving pieces, right? So when we were starting to get this framework off the ground, first thing we did was like, all right, let's call every investor in our network, get their opinions and what the types of information that they ask in a due diligence process, and then let's go talk to projects. Then there we have the supply and the demand. But the reality is there's a bunch of other nodes in this operation, if you will, where the market makers and a lot of projects have NDAs on their contracts, and that's natural how you would run that business. And I was a little bit nervous to have market makers like involved in this because like, all right, are they going to want to tell this information to the market? But the reality is they do. When bad actors take advantage of these situations and they don't know about and maybe another player who has access to a large portion of token supply, then they're the ones in the order books that are buying those tokens that are just being dumped on top of them. And that is the very interesting angle that was really eye-opening to me. And I think it's just a good testament to the industry recognizing how big of a problem the lack of disclosure is and everyone kind of rallying behind and wanting to drive this change forward. So yeah, I'm Felipe. I'm curious to ask you though, when you look at the framework today, like where do you see opportunities for growth, and whether it's the questions we're asking, the language we're using, or any areas of opportunity just to harden up the framework itself?
Well, I think over time people will provide more detailed answers with more backup. So right now there's an open question: will the framework lead companies to re-rate? Will tokens that are on the framework trade better at higher valuations than tokens that are not in the framework? I am confident the answer is yes, but the market needs to prove that to tokens over time, right? But then once you get people competing and you give them a place to make this credible signal, what happens is that they'll notice, one, that they get points from investors, and two, that they can get more points by being more detailed, more transparent, more on-chain. So for example, you have a section where you ask about assets and expenses, right? People are giving you kind of high-level answers. Here's what we have. Here's how we track it, and that's fine. It's better than it's better than nothing. It's better than -2. But I think over time you will see tokens realize this is really valuable to people, right? And start to peacock essentially by putting their on-chain wallets, creating quarterly expense reports. Because you created this zone of competition, people will try to outdo each other and dunk on their competitors, and that will create its own positive feedback loop. So I think that's why it's so important just to get the framework adopted and make it an arena for competition between tokens competing for capital.
Yeah, so 2 points on that. First point is, Dan said earlier, it's very cheap for teams to do. It's also free advertising for these teams to do. They're rushing in. People, they want their name out there. They want they want good press. To have a 39 out of 40 score on the token transparency framework, they see as very good free advertising. Second thing is that we're already seeing that competitive process. We had all these submissions come in. We said, hey teams, here's your score. They all said, wait, that's not good enough. Like, we want to disclose more. So they launched blog posts and they made public new information that they originally did not intend to. We're even seeing projects that are competitive starting to compete on who's more transparent and elevating their disclosure standards to appeal to the market. Like, we're seeing that this thing has been live for a week and we're already seeing really, really tangible progress.
I think we're pretty close to a classic standard diligence question being, why aren't you on the token transparency framework? I mean, we're going to start asking that. We already are asking it, right? Right now you have an excuse, which is like, I'm working on it. I'm working with Dan or Ryan. But in 6 months, that excuse is gone, and I think people will be pressured.
Yeah, that's a great point. You also brought up the expenses piece. So one of that was probably the most under-disclosed portion collectively within like a single line item in the framework. And the interesting response that we saw with teams was like, hey, like, if I put this information forward, then I'm putting myself at a disadvantage. So it's like, how can we get which is fair. Again, these are all competitive startups in many cases, but it's like, how can we as an industry be like, okay, if we get everybody doing this simultaneously, then you kind of get that unlock where there's maybe not like a first mover disadvantage. But to your point, the first people who are going to be wanting to do that are the ones who have extremely low expenses and are generating real profit. And that's what kind of sets the benchmark. And you've given the croaking frogs example before. I love the word or the phrase credible signal. I think that achieves this as well. And I actually do think that's exactly how this is going to play out.
Should we tell the frog story?
Yeah, tell the frog story.
So there is a type of frog that mates based on how deep their croak is. And what happens in every pond is you have silent ponds, but as soon as the frog with the deepest croak croaks and shows that they're like, a 10 effectively on that mating scale, the 9s realize, hey, people think I'm a 4.5, because that's the average of the non-croaking frogs. And they croak. And then the 8 realizes that people think they're a 4. So they croak. And the pond goes from being silent to fully self-disclosed within a few hours. And I hope that's the process that we started here with the framework.
Yeah, no, I love that. And again, I think we're seeing that play out in real time. So I think the overall call to action here is projects. We want to get you listed. Please reach out. Centralized exchanges, I think, have a very strong foothold over being this meaningful filter to the assets that retail gets to interact with. Right, like many people just say, all right, I'm going to log into my Coinbase or my Binance or my OKX or my Bybit wallet or my platform, and that's the assets I'm going to trade. It's a fewer number that are actually on chain. So they do play this meaningful role. And so one, I'd love to see it part of the listings process. If you want to list an asset, you encourage them to do this framework. And again, that's another end user we had in mind while building this. Because if it's not useful in that process, well, then we've probably missed on a few questions, and we'd love to, again, continue to evolve and iterate this framework. The other one is market makers, right? If you're going to work with these teams to make their token, we'd love to see you encourage them to go through this framework as well. Push those projects through this framework, again, because you can protect yourself by knowing the other players that are involved, or if the foundation tokens have a vesting schedule, or who has control over those foundation tokens. Right? That can ultimately have a negative impact on the market structure around the token as well. And then again, the last one is professional investors in retail. I think this is incredibly useful going through those due diligence processes. But guys, is there anything we missed? Anything we want to touch on?
Yeah, I think that regulators have a job to do, and it's often hard for them to do that job. You're waiting on, the SEC wants certain things to happen. They might not get them via legislation. And this standard it's explicitly going to fill gaps in the market. It's going to do the job. Like, we're a nimble startup compared to the SEC, so we can move faster. And the industry trusts Blockworks to steward this. And so I think it's going to be really helpful for regulators for sure. It's also really important to accelerate the effort, because we will see regulation one day, meaningful regulation. I don't know exactly when or what the degree will be, but you want to get the industry in a trusted space so that that regulation, when it comes, is not punitive. There is a real risk of regulating the industry in the wrong way, because we have a history of illicit behavior, bad actors.
Yeah, I think that's a good
so
point.
It's important we do it today.
But why the time is now, right? You do see the market maturing in many different angles. You see more large TradFi fintechs or banks or financial institutions coming into the space, and they expect this kind of logic. We see meaningful regulation moving through Congress, right? The market structure bill is still in the drafting process. We see the stablecoin bill, the Genius Act, moving its way through as well. So the time does feel like now, where not only does the market know this is a problem and actively wants a solution, but the regulators are thinking about this as well. And so it's like, you can imagine a world where your teacher, your parents, like, catch you in the act of doing something they weren't, you didn't want to do. They walk in your room, it's a mess, right? And if the room's a mess when they walk in, it's gonna be very hard to justify why you should be the one to help them bring it back in order. Right? They're just going to want to do it themselves, and you're probably not going to like the way that ends up, right? So when the regulators do come into, and they're already looking actively at the space, like, all right, there should probably be a disclosure regime here. Does anything exist? It's like, oh, it's this one that was grassroots, built from the industry, evolved through the course of 6 months to a year. And like maybe that's the way that this ends up going. Is like, oh, okay, this is like a very good framework. They've figured out the nuance within the industry, mapped that to the existing financial system, and then kind of figured out a way to push everyone forward collectively. And I think self-regulation is probably the right path forward. But Felipe, yeah, I'm curious if you have any thoughts around why the time is now.
Yeah, well, I think, why hasn't it happened is an interesting question. My best guess is just the period of 2021, there was free money in the market, so nobody cared about transparency, nobody cared about cash flow. There was no competition for capital because capital was infinite. 22 to 24, Gary Gensler was at the SEC, and you didn't want to market yourself as an asset, right? You wanted to be perceived as kind of a silly nothing that doesn't have any value. So going out there and seeking to give investors what they need to do diligence was seen as a negative, which is very counterproductive. And now we have the right conditions in place where people are competing for capital. Capital is no longer infinite. Rates are at 5%. And an SEC that looks kindly on, or appears to look kindly on, self-regulation, attempting to get the house in order at an industry level. And it hasn't been that long since we have both of those conditions.
Yeah, completely agree. Well, awesome, guys. This has been a fantastic conversation. If you want to view the framework or any of the responses we've got, again, that's at blockworks.co/token transparency. You can just go to the main page. It's in the top right corner. You'll see it. But yeah, if you have any feedback on the framework, we're all ears. We know that this is an evolving framework and are really excited to iterate on it, and we're happy to talk about it. But thank you.